Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another live stream Sunday. Try doing these every other week. It was off last week because I was at a financial conference, but thank you for coming back. I love these little informal bi-weekly chats, just a way to connect with you, take off the bow tie, and really kind of just talk about a topic in the markets and then answer your questions. I'm on coffee this week, but if you want to have your own little adult beverage there or whatever you're drinking, then go ahead and do that. I want to stay alert though because I want to make this a longer than usual live stream, answer as many questions as I can, and just kind of reconnect with all you out there in the nation. So thank you again. I see a lot of the OGs of the Bowtie Nation, the citizens there. Ambrose from New York, Fisk, Somalia, Michael. Good to see you here. Everybody from our friends from Russia, Melbourne Beach, Florida. Everyone out there, thank you. Thank you for being here again. And it's a timely and important topic this week, right? Everybody excused me of fear and uncertainty, in our last live stream because I kind of talked about some of the things that was potentially pushing the market down in September, and we know the result, right? The market was down about 5% since then, and the problem was these traditional safety investments didn't work. So we're going to talk about that, but you can see here the S&P 500 was down about 4.5% for the month of September. The NASDAQ was down about the same, about 4.4%. So both of them down almost 5%. And again, the problem with this was that those traditional safety investments that people think about when they, when they think of a market sell-off and protection, they just didn't work. Okay, the Spider Gold shares, that's ticker GLD, was down. That was down 3.5%. The Vanguard Bond ETF, so the ticker BLV, an ETF of bond investments, was down 2.9%. And then, so both of those actually did beat the market, did outperform stocks. So they did provide some kind of safety, but they were still negative returns. And then you had the Spider Utilities ETF, that fund of utility stocks. Supposedly, protection from those growth stocks and those other stock themes out there, fell more than 6%, fell 6.8% over the last month. So definitely did not provide that kind of safety or protection that investors typically look for when the market crashes or just when the market heads into a correction. So what I want to do with this live stream is kind of talk about the reasons why those traditional safety investments aren't working, those safety stocks and other investments, and then kind of read into what's been happening in the market to find better safety investments, things that if the market does keep going down, in the month of October, November, then you can still protect your money and maybe even get a little bit of upside return on that. Again, it's not that I'm calling for a stock market crash here or even a significant correction here. We're already down about 5-6% from those peaks set in early September. So it's heading close to a correction, which is about a 10% sell-off from the peak. But I don't think it's going to get that bad. It's not going to get any worse than 10 or 15%. And we'll talk about reasons why. I think that we're not going to get a stock market crash, but we still could get that correction over this next month. And a lot of it has to do with the earnings season. What we saw out of Bed Bath and Beyond last week, I think, is a real big warning sign for a lot of these. So we're going to get into that. But I also, before we get started, I also want to invite everyone to sign up for the weekly bow tie, and I actually need to fix my promotional video here because it is now weekly. I was doing this as a daily thing, but it's now weekly, every week, Sunday night. So there'll be one going out tonight. All the market recap of the past week, market outlook for the next week, strategies, trends I'm watching, all completely free. Basically, just look for that link that I left in the top of the chat there or in the video description below. Sign up. Again, it's completely free. Just something I like to do for all you out there in the nation. Just a recap and an outlook for the week ahead. So check that out, and we're gonna get started because like I said, this is an important and timely topic. Again, stocks fell over the last month. Actually, last month was the worst The worst performance for the S&P 500 for the broader market indexes since March 2020, and we all know what happened in March of last year with that huge crash around the pandemic. But this was the worst month, and really I think only one of maybe 2 months that have been negative since that March crash. So definitely a sell-off. And again, those traditional safe stocks, the stocks that are supposed to save you from that stock market sell-off, didn't work. So we want to look at why the stock market sold off, why those safety stocks didn't work, and then what might work going forward, and kind of an investing strategy. So we want to look at some of these reasons, and let's go to some of the charts I've got set up here for you. First is let's look at why stocks are falling, why the markets are running into that difficulty over the last month and could be going forward, because I think that really helps you paint a picture of what might work and what hasn't worked as far as that protection, that safety stocks and that kind of thing. So first is just interest rates, right, and the Fed policy. You cannot look at a chart of the Fed stimulus, fiscal stimulus, all the stimulus money that's been coming out of the government over the past 2 years, and not draw a direct correlation with that and stock prices. Okay, it's almost one for one, right? A lot of the stock market is being driven by ultra low interest rates, near zero, basically making it easy money and free money to borrow, which is just going right into assets, right into stock investment, as well as that Fed policy. The Fed has increased its balance sheet from about $4 trillion up to almost $10 trillion just in the past about year and a half. Okay, and obviously, when we talk about the Fed increasing its balance sheet, that's the money, that's the assets it holds on its balance sheet. What we're talking about is the money it's pushed out into the economy, right? Because when it does that, what it does is it sells bonds, right? It sells treasury bonds out into the market, or it buys bonds. Excuse me. Obviously, the Treasury issues those bonds. The Fed buys those bonds and pays cash for it and pushes that cash out into the economy. Okay, that's one of the big levers the Federal Reserve, the central bank, has to juice the economy, is it buys bonds and pushes cash out into the economy, right? And what we're talking about now lately is that it's going to stop doing that. It's buying $120 billion worth of bonds each month, and it's talking about buying less of those bonds, right? And that's having an effect on interest rates, right? Economic growth, inflation, a lot of this stuff is pushing interest rates up. And what we see here in this graph, this is the Treasury yield, the rate on the 10-year Treasury bond, U.S. government Treasury bond. You can see it started out the year right at around 1%, right? It was actually like 0.95% in December of last year, and really quickly shot up to about 1.7%, a little bit higher than 1.7% in March. That's when we saw that huge sell-off in growth stocks, right? And actually some market weakness as well. And the problem there, especially with tech and growth stocks, is that the way stocks are valued, okay? A lot of these stocks, with their cash flows and expected returns far out into the future, okay? A lot of these companies, they don't make much cash now, they don't make much income or earnings now, but they're expected to, make huge money in the future. Well, the way you value that to a present value, to find out what the stock is actually worth right now, is you discount those future cash flows by an interest rate. Okay, so you discount, you reduce those future cash flows depending on which year into the future they come by an interest rate. Okay, so as that interest rate gets higher, those future cash flows become less valuable right now. Okay, because you're discounting them, you're reducing them by that bigger amount. Okay. And so, what we saw here into February and March is that rate just zoomed up, boomed, and gave investors a lot of other alternatives, right? You'll hear a lot in the market, a lot of market pundits right now talk about TINA, right? TINA, T-I-N-A, there is no alternative, okay? And that's just the idea that with rates so low, with rates near zero, 1%, 1.5% on the 10-year Treasury, then there's no alternative to a return, okay? You can't put your money in a treasury bond right now because you're earning less than the rate of inflation. You're actually losing money with that investment. So people are just pushing all of their money into stocks, and that's really holding up stocks. Well, what we see is then obviously as that rate goes up, then there is an alternative. There that people can invest in new bonds and other things, and people don't need the risk of stocks. So we saw the 10-year rate come off quite a bit into the summer, but then just recently it has jumped again. So it jumped up to about 1.55% this week. That was a lot of the sell-off that we saw in stocks. People just worried that that higher interest rate is going to slow down the economy. It's going to make the cost of money quite a bit more. Cost of debt. A lot of these companies have a ton of debt over the last year. And so that's going to hold things down. So that's one of the things, one of the reasons why the stock market has fallen lately, and a really big reason why a lot of these safety stocks that we're going to look at pretty soon just haven't worked. Okay, a lot of these are really yield sensitive stocks, and we'll talk about how that works and what that means here in a minute. But next, the other issue we're looking at is energy prices. Having an energy crisis going on right now, not only in Europe, Asia, in the U.S. to a point, but not quite as much as we've seen in the past, and not quite as much as some of these other regions in the world. The U.S. is really almost energy independent right now. We are producing more than we consume, so we're exporting. We're a net energy exporter. I believe we're actually up to exporting about 10% of our natural gas production, right? And that is a huge jump from about zero only as early as 2014. I think 2014, 2015 was when those first big ports or big processing stations there in Louisiana, I think, was the first one to process that natural gas into NGL, into liquids, and then be able to export that, and we're approved for export. So we're actually from about 0% export on natural gas in 2014 to 10%, a tenth of our natural gas production, exporting that now out, and that's really driving the price of natural gas. Europe is in a natural gas crisis. Prices have jumped by double over the past year. Prices for natural gas are $6 now, as opposed to $3 at the beginning of the year. And we're not even into those big winter heating months. Okay, oil, you see here the crude oil. This is the West Texas Intermediate contract for futures. Hit $80 last week. It's up 60% for this year, which is a huge move in oil. We've been bullish on oil all year round. It's a big part of the 2021 Bowtie Nation portfolio, which is now beating the market by about 13% this year. And is about a 27% return so far for the year. And that's a lot of that is due to some of the oil stocks that we've held. Right now, as we get up into the $75, $80 per barrel range and higher, that's really where you start to see oil and energy prices start to limit the economic growth. Okay, so that's what a lot of the world is looking at. China and Europe, like I said, are facing their own energy crises where no matter what the price, they just don't have enough of these natural gas and oil right now. So that's really weighing on the market. And the third one here that we're looking at is really just the big wild card out of China. Okay, it's come down a little bit with that Evergrande crisis there in China, but it's still a big factor on fear and uncertainty in the market, and just one more thing holding stock prices down. So real quick there, Evergrande is actually the second largest property developer in China. It's one of the largest in the world. And with China, you got to understand, property is such a big part of the economy. Okay, the equity market really isn't as well developed in China, so people don't have that stock market to really invest in like they do here in the U.S. or in Europe. So typically and historically, they've put the money into houses and into properties. And actually, there's a lot of people that basically are just buying vacant apartments and apartment buildings, whole apartment buildings that are just sit vacant. And it's actually still a good investment because property prices have increased so much over the past 10 and even 20 years. And what we're seeing here, so that's property and real estate is about a third of the economy there in China, as opposed to about 18% here in the U.S. and about that same percentage in Europe. So a much larger section of the economy, part of economic growth. And what we're seeing is obviously this Evergrande, this property developer, is missing its payments. It's going bankrupt, right? It's already missed 2 or 3 offshore bond payments, right? When a company issues bonds, it borrows that money and tells those bond investors that I'll pay you an interest twice a year, usually twice a year, until the bond matures, and then I'll pay back all of that loan. Well, the foreign investors in these bonds have missed two bond payments, right? Or the company has missed 2 bond payments to the foreign investors. Now they're still paying a lot of the onshore bond investors, so a lot of the Chinese investors. They're still paying them, and the Chinese government is really watching this closely to make sure that they don't hit a lot of their domestic investors, but they're letting them default on those offshore bond investor obligations. Now, technically, the company has 30 days to make those payments before it's called a technical default. And when that happens, a lot of their other bonds, a lot of this other loans that they've issued becomes, technically in default as well. It's just a part of the covenant that says in a bond that says, okay, if you default on one bond, if you don't pay the loan payments on one bond, then then this other bond defaults as well, and all the money needs to be paid right now. Okay, it's just it's a safety measure by bondholders to say, okay, if a company's getting in trouble with some of these other bonds it's issued, we want our money as quickly as possible because we don't want to wait. And so it's got 30 days to make those bond payments before a lot of these other bonds are in technical default. That's really going to be the red zone, the red line for this company, because I don't think it has the money to make a lot of these bond payments. It did just sell some assets last week for $1.5 trillion or $1.5 billion that should cover some of these bond payments, but I don't think it has enough to really keep managing these bond payments. So probably in about 30 days or so, we're really going to see if the Chinese government is going to step in, save this company, or how far down they're going to let it default and go bankrupt in these bonds. Obviously, it's holding down property prices. It's causing a property crisis there in China. And because that is such a huge part of the market, of the economy, then it's flowing through to economic growth in China and outside there too as well. A lot of foreign companies, foreign investors, pension funds, foundations, things like that own bonds of this Evergrande company because it was so large. So obviously it's knocking them as well. So, those are really the 3 main causes. There are other little things going on in the market, but those are 3 of the big ones that are affecting the market, why it had that big sell-off in September. Now let's talk about, why, how long this could last, what could happen, and, why some of those traditional safety stocks and safety investments aren't working before we look at kind of what might work. The base case, what I'm still looking at is still just a minor correction. Okay, I'm looking maybe we get another 5% in the month of October, 5% sell off. So get to that 10 to 15% correction on the markets from their peak in early September. But I don't think it gets worse than that. Valuations are historically high, and rates are expected to continue increasing. A lot of economists believe that 10-year treasury that we looked at that is now at about 1.5% could reach 1.8% or 2% by the end of the year. So again, that's just going to increase the cost of money. That's going to decrease the valuation for a lot of these growth and tech stocks. So I'm thinking, about another 5%, over the next month and a half at the most, really. And one of the biggest things that I think could trigger this, could trigger another sell-off, is just as we get into earnings. If you look at the earnings of Bed Bath & Beyond last week, I think it was a major warning sign. The CEO there talked about all the supply chain issues they've been having, the inflation in their own costs that they've been having, and it really came through to a reduction of sales. They missed sales, top line revenue, I believe, as well as earnings, or it just didn't come out as expected. And I think that's going to be what we see with a lot of companies as they start reporting. Okay, so third quarter earnings season is just starting here in the next few weeks. Okay, so that was January, February, March is the first quarter. April, May, June is the second quarter, and then the third quarter is July, August, and September. Right, so companies are going to soon start reporting those 3 months, the earnings over those 3 months. And what I think is going to happen is a lot of them are going to start saying the same thing that we saw with Bed Bath & Beyond. They're going to start saying, look, man, our supply chains are just broken. If you look at a satellite picture of all the ships lined up outside of Los Angeles, outside of New York, It's just snarled traffic. It is a traffic jam out there. So a lot of these companies, they can't get their product and the things that they need for manufacturing or the finished products, from these other countries, and that's causing a real supply chain problem, right? That's pushing prices up for goods. We've got inflation coming from other parts of the economy. That's pushing prices up. So companies haven't yet put out or increased their own prices, a lot of their own prices, but they're seeing higher costs for a lot of their materials and a lot of their supplies. So that's lowering earnings, lowering profitability, plus just the simple fact that they just can't get all of their supplies, all their materials. That's lowering revenue. So it's kind of a top line problem and a bottom line problem that I think you're going to we're going to see a lot of these companies during the third quarter earnings release talk about that, not only for the third quarter but looking ahead. Generally, for earnings reports, what you want to look at more is the outlook, the things they say for the future, because most people, most stock market analysts and the market in general kind of knows where earnings are going to be. Obviously companies always beat those earnings expectations because they manage those expectations through the quarter, but they're generally pretty close. What is really important is what they say for the next quarter and for the next year. And I think we're gonna get those same warnings that we got from Bed Bath and Beyond, and that's going to spook the market. Okay, the market is actually going to start thinking, okay, crap. If supply chain problems get any worse, if inflation gets any worse, we could see a major downgrade to what we think companies are going to earn over this next year. Okay. So I think that's probably a lot of what's going to cause maybe this next 5% lower over this next month. But again, that's just the base case is still that relatively modest 10 to 15% correction in stocks versus the peaks that we saw early last month and before that. I don't think a major crash is going to happen, and it's basically just because households have almost $2 trillion in pent up savings that they have. A lot of companies have an immense amount of cash that they've saved up. A lot of companies just borrowed through the nose last year, borrowed as much as they could at those lower interest rates, conserved cash just in case things got worse. And of course, they never got worse economically. So they're sitting on a ton of cash. And they're going to get ready to spend that. Okay, they're going to be buying back shares. They're going to be investing and making acquisitions, things like that. So a lot of things that are going to really support the economy, support corporate earnings, to where I don't think we get a major crash, which would be 20% or more sell-off from the recent lows. Now, what I do think you need to watch out for is a crash is going to eventually happen. It always does. And one of the things I'm looking at is you only have to look at a chart of the NASDAQ, or we could use the ARK-K. Okay, we'll look at the NASDAQ here, and you can see, this is a 5-year chart, 16, 17, 18, all pretty good returns, really good returns through those last 3 years there. Right around 12, 15, even 17% over those years. And then they just went exponential. The return on the tech-heavy portfolio of the NASDAQ just jumped, basically almost doubling from March of last year to current. You can look at other ones that are kind of indicative of that market. So let's look at the ARK-K, the ARK Innovation ETF, and you see the same thing. You see, we'll see here, returns did pretty well 2017 through early 2020, and then we got all of that money pumped into the economy, all that, the fiscal stimulus, the Federal Reserve, the low interest rates, all that money that was the stimulus that was a part of the rescue package for the pandemic, and we did need it. Without all that money pumped into the economy, we could have been in something like a depression. So we did need it, but it has just gone on for way too long, and all that. So you could see the ARK-K doubled here, almost tripled, right, from January of 2020, February 2020 to January of this year. It's since come down a little bit because investors are looking at the Fed pulling back on some of that stimulus and the fiscal spending and that kind of thing. But you only have to look at these charts to think, okay, the stock market obviously broke over the last year. Stock prices do not rise this fast, this far and this fast in a normal environment. So what happens if that comes off? As we do see interest rates rise, as we see the Federal Reserve stop pumping so much money into the system, as we see the government stop spending quite as much money, right? There's going to be disappointment. And we're also looking at higher taxes, higher tax rates, right? So over the next 2 to 3 years, I would expect, at least maybe a 25% drop in the stock market, just as, that market gets back to a little bit closer to normal. Okay. Now, obviously, this is going to change how you invest, depending on who you are, when you need that money, and that kind of thing. If you're an investor that still has 10, 15, 20 years left to invest, then I would say that it really doesn't affect you too much at all, right? You can just, invest as you normally do, put money into stocks every month. And, if there's one truism to the market, it is that it does eventually go higher. Even if we get that 25% stock market crash over the next between, not necessarily next year, but maybe mid next year to a 2 to 3 year outlook. Even if we get that, then the stock market's going to recover. You're going to see higher prices over the next 10 years, and you're going to be okay. If, though, you are within maybe, I'd say, 5 years of retiring, of needing that money, 5 years of, whatever you want to do with that money, then you're going to want to pull back. You want to look at some of these traditional safety stocks that we'll look at, or some of the other safety stocks that have been working, and you're going to want to look at maybe some of these other call option strategies, like a covered call strategy, okay? So now I want to talk about, real quickly, why some of these traditional safety stocks haven't been working, these safety investments, and then move into what is working or what will work to kind of protect your money, but also give you that interest or that potential return. Okay, because the problem with a lot of this is, yeah, you can shift your money into safety stocks or safer investments, but then you don't make a return, and like we talked about with that TINA, there is no alternative. Yeah, you can be in bonds, and they've done relatively well, not as well as they have in the past, but you're just not making any money. You're actually losing money with a lot of these bonds, because of inflation. So we want safe investments, safer stocks that are still going to provide you with that protection, but also with some return upside. Okay, so first, why some of these traditional safety plays haven't been working. Okay, bonds, obviously the traditional, the ultimate safety stock. These are obligations by companies. They have to pay those bond payments, make those bond payments twice a year. That's interest payments, and that's something that they're contractually obligated to do. They don't have to pay out dividends. The stock price doesn't have to increase, but they have to pay their bondholders, right? So this has always been, the safety investments versus stocks. And like we saw with that, with that chart, the BLV, the Vanguard Bond Fund, the Bond ETF, a fund of long-term bonds, has lost money. It lost about 3% last month, right? And this is a big factor of this is interest rates. Okay, again, as interest rates go up, then that gives that reduces the value of bonds, okay? Because those bonds are all issued with a fixed interest rate that they pay out that two times a year, okay? So, if a bond was issued last year with a 3% interest rate, which means it pays out 1.5% interest on that bond investment twice a year. If it was issued at 3% last year, which was the market rate for that bond, now interest rates go up. Interest rates go up, and the market interest rate for a similar investment of that bond would be 3.5% or 4%. Well, now new investors are looking at, say, okay, this older bond that only pays 3%, this new bond only pays, this new bond is going to pay 3.5% or 4%. Well, obviously they're going to pay this higher interest rate bond. These new bonds that are now competitive at these higher interest rates are much more attractive. Well, okay, what happens? What happens is this older bond, the price has to come down. Okay, the price has to come down so that interest rate that it's paying, the actual effective interest rate goes up. Okay, so that's why bonds aren't doing well, is because as interest rates go up, bond prices come down. Okay. Now, as far as stocks, why haven't utilities and consumer staple stocks performed very well over the last month? Utilities and consumer staples, both supposed to be very strong, stable, and safe sectors. Okay, you have to buy electricity, you have to buy your natural gas, you have to buy your food, and the other things that those consumer staples companies sell. These are necessary products, so their cash flows and their sales tend to be fairly stable, even if the economy falls. But again, we saw a 6.8% drop in the stocks in the utility sector last month. And part of this is those interest rates again. As the big return, the biggest part of return for utility stocks, for consumer staple stocks, is in that dividend yield. That is like 50% of the return on those stocks. That dividend yield. Well, what happens is as interest rates go up, then investors say, okay, you know what? I can get a 2% dividend yield out of this utility stock, but interest rates are going up. And so now I can get a 3 or 4 or 5% interest rate on these high yield bonds, right? So I'm going to go for the high yield bonds because they're safer than the utility stocks. They're safer than the stocks. Plus, they also pay a higher interest rate now. Okay, so as interest rates increase, you start seeing investors get sucked out of those yield sensitive, those yield paying stocks like utilities, like consumer staples, and even like real estate, really. Another thing, inflation. Consumer staple stocks have been hit really hard with inflation, as well as a stronger dollar. A lot of those companies, Procter and Gamble, Johnson and Johnson, things like that, they have a lot of sales overseas. So as the dollar gets stronger, that makes a lot of those foreign sales, the sales they made in other currencies, worth less. Okay. And their exports out of the U.S. are more expensive, but as well as inflation. We already talked about how a lot of these companies are seeing massive inflation in their own input costs or input materials, the things that they use to make their products, agricultural commodities, things like that, and it's really weighing down the earnings, limiting the profits of these companies. Okay, as well as higher energy costs obviously have been hitting the utilities companies as well. Last year, gold. Why has gold kind of has not performed as well? And we can look at the gold here. It did have a really nice jump into the end of the week here. You can see here over the last month. Okay, so over the last month, it opened September 3rd here, 1829, and was on track to fall down to 1727. So about 100. That would be, I think, about a 3% return. 1829. That's actually about a 5.5% loss on gold. It was on track for a 5.5% loss. Massive rally back here in the last day of September, back up to 1758. But it still closed negative. Okay, so it still closed about 3% down for the month. So why did that happen? Why wasn't gold that safety investment, protecting investors from the stock market sell-off? And here again, a lot of it is also that interest rates, but also the dollar, right? All these commodities, gold, oil, a lot of those commodities, they're all priced in dollars. Okay, so even internationally, they buy and sell gold in the U.S. dollar. Okay, so what happens is as the value of the dollar increases versus all these other foreign currencies, then these commodities come down. The commodity prices come down, okay, because they still have that fundamental value, but they're priced in dollars. So dollar goes up, a lot of these commodity prices come down. It hasn't happened with oil just because of the other supply and demand factors in oil, but the value of the dollar is always a big factor in commodity prices, and it's really hit the value of gold here in the last month, as well as interest rates. You earn, if you hold physical gold bullion, you make nothing. You earn nothing until you sell it. Okay, and for a lot of people, there's carry costs for gold futures. There's storage costs for gold. There's a lot of costs for holding gold. Okay, so the interest rate that you can get on other investments, the interest rate on bonds, the interest rate or the dividend yield on dividend stocks, that is kind of like an opportunity cost, right? So the higher interest rates mean you could be making more money rather than paying money to hold your gold. So it's a real detractor from gold as an investment. So as interest rates go up, as the value of the dollar goes up, then gold prices tend to go down, and that's why we saw that didn't work very well last month. Now again, for a lot of these, so bonds, utilities, utility stocks, consumer staple stocks, gold. So a lot of it was interest rates, and again, we are looking at higher interest rates through the rest of the year. Again, it's about 1.5% for the 10-year Treasury bond right now. It's expected to go up to at least 1.8 or 2% by the end of the year. So that means that these safety stocks, these safety investments, will still be limited, through the rest of the year and probably into next year as well. So those didn't work. What will work? What might work over the next 6 months or so, as we start seeing a little bit of weakness in the stock market, especially here in October when we start seeing those earnings come out? What might work there? And the first thing I'm really looking at here is banks and insurance companies, okay, financial companies. And we can actually look at the sector tracker here to kind of get an impression of what has worked over the past month, why, and what I'm looking at. So if you see, you look at the sector tracker, this tracks all 11 stock sectors of the economy, and how they did over the past, well, here we have over the past month. And you can see, okay, so energy, the only stocks in that sector actually increased by 13% over the last month, a huge resurgence in energy. And in fact, I think, like 7 or 8 of the top 10 here over the past month were all energy companies. So obviously energy doing very well. Probably will continue to do well, as we talked about that energy crisis in Europe and China isn't going away soon. We just aren't producing. The U.S. producers are not increasing their production quite as fast as we thought they would. So we're actually coming into a shortage versus the demand from all the economic growth. So energy prices probably going to stay higher. In fact, I think Goldman Sachs or JP Morgan is actually forecasting up to $100 barrel of oil by the end of the year. It's at 80 now, so that would be a 25% increase from where we are now. So energy stocks should do well. Okay, energy stocks should be one of those ones that help. Now, it's obviously going to be more volatile. This isn't quite a safety stock or a safety investment, those energy stocks, because they do tend to rise and fall very quickly. But what is more of a safety investment are these financials. Okay, you can see, so after the energy sector, the stocks in the financial sector did second best and almost a positive return, 0.08% negative return over the last month, and a big, they actually did really well over the past 5 days or 2 weeks, right? As those interest rates increased. Okay, so they were still negative over the past 5 days, but over the past 2 weeks, they've done very well. And a lot of that is because, okay, think about how banks make money. They lend out, those long-term interest rates, and they borrow or they take your deposits and pay you those short-term interest rates. Well, the Federal Reserve is saying we're not going to budge on short-term interest rates for at least a year. We're not going to raise short-term interest rates for at least a year. So those are still going to be around zero. So all of you with savings out there in a traditional bank, you're not going to make anything for at least a year. Those interest rates are going to be zero. But the longer term interest rates are increasing. Okay, so banks are going to be able to charge that higher interest rate on their loans. Loan demand is coming back. It was really low there for about a year because nobody needed loans, right? We were getting all this money from the government. Nobody needed to borrow. So loan demand was very low, but it's starting to come back. They're making more money on these loans that they make. So banks are going to do very well as interest rates increase. It's why this is important as a safety investment, because I know a lot of you still have a lot of tech stocks, a lot of growth stocks that are going to be hit by those higher interest rates. So you really do need to be balancing that out with some of these bank stocks, with some of these financials, right? Because those are going to do well when interest rates increase and are going to balance out maybe your losses in some of those tech stocks and growth stocks, okay? So those do well. Insurance companies within the financials do well also, and that's because, okay, think about how an insurance company works, okay? It takes in your premiums, and then it promises to pay out in the future, when that policy is collected on, whether it's life and death, whether it's property casualty, things like that. So they have an immense amount of cash on hand that they hold to pay out these policies. What does it do with that cash? Okay, it obviously can't invest in stocks because what happens when a stock market crash, then it could lose half or more of its cash reserves. It needs something very safe to invest in. So mostly insurance companies, they invest in very, very safe bonds, okay? Bonds of highly rated companies, or just treasury bonds, okay? and they've made almost nothing on those, right? Interest rates have been so low for so long that they've made nothing on those investments, on that cash. Well, now as interest rates start going up, these insurance companies are going to start making more money on that cash. And that's going to start coming through in their earnings reports. Okay, so again, very important, I think, especially if you still have a lot of tech stocks, a lot of growth stocks that are going to hit as interest rates increase, that you balance that out with more investment in these banks, insurance companies, in these financials. Okay. Energy, we've already talked about, those energy stocks. I think those will continue to do well. Also, as the price of oil and the price of natural gas remain high, consumer discretionary, I think, could be one of the ones that does well also. If we look here, and consumer discretionary stocks, those are companies that sell, retailers, so clothing, things that you don't necessarily need to buy, but you do anyway. A lot of entertainment stocks, travel stocks, things like that. So, and with any of these, you can click through these sectors and see kind of some of the examples. Okay, so for consumer discretionary, we see Caesars Entertainment, Expedia, Marriott, Norwegian Cruise Lines. So a lot of those travel, leisure, entertainment retailers, so the car makers, so General Motors and Ford are in here as well as the auto parts companies. So, and why I think these could do well is a couple of different reasons. One is that we're just getting more reopening. Okay, right? The Delta surge in the COVID cases has started to come down. And is forecast to keep coming down. More people are getting vaccinated, so a lot of the fear over COVID is coming out of the market. People are getting out, they're spending that money, so that's going to drive a lot of these stocks that have been beaten down over the past year. These, the cruise lines, the travel companies, the hotels, things like that. That's going to drive those, the Vegas companies, things like that. Also, though, is just like what we talked about, that household spending, that huge $2 trillion savings that households have saved up over the past year. They're finally getting out. They're going to be spending that. And I think that's really going to drive a lot of these consumer discretionary stocks, right? So not necessarily a real strong safety play. Like I think those banks and insurance companies are probably your best bet for safety. But still something, these stocks in this consumer discretionary sector are still something that I think is going to outperform the market, especially on some of these other ideas of higher interest rates, higher inflation, things like that. Okay. But you also want to look at other assets, and this is I know still a lot of people still aren't really into cryptocurrencies, aren't buying cryptocurrencies, and are still skeptical. But you really do need to expand out into other assets besides stocks, whether that be real estate, whether it be some bond holdings. I wouldn't hold a lot in bonds right now, but maybe some bonds, as well as cryptocurrency. It is undeniable that cryptocurrency is becoming a major asset class. And about 13%, I think about 13% of people, 14% of Americans out there own cryptocurrency. That's increasing every year. It is becoming an asset class, and it's not going away. So I would, I am investing quite a bit of my portfolio in cryptocurrencies, not only for that growth, but also just diversification from stocks. Okay, it is disjointed from stocks. It's not crashing and rising right along with stocks. So I think it's something that's going to smooth out your your portfolio and your returns a little bit if stock market does continue to cool off. So now I want to kick it over to the question and answer. Obviously always my favorite time of the live stream. Get to answer your questions and talk back and forth with you here.